Many said FICO had the strongest moat on the planet, so why has it dropped over 44% in a year? In this video, I'll be covering exactly that, along with its Q2 earnings, why it had the strongest moat on the planet, my valuation on the stock, and whether it's a good buy today. Trust me, by the end of this video, your understanding of FICO will have completely changed. So is FICO a buy now, down 43% already? Now, to understand this, you need to understand what does FICO do. Fair Isaac Corporation, or FICO, has established itself as the industry leader in credit scores. This has turned out to be a very lucrative business. If you live in the US, you probably already know what a FICO score is, ranging from 300 to 850. And it's essentially just, your credit score. But the credit scores are used for more than just individual lending decisions. They are benchmarks used by investors, lenders, and the industry overall. Now, we'll get more into that in a second. That is very important to remember. So when it comes to their revenue, they don't just offer FICO scores. They also have the software side of the business and a small section for professional services. But the majority, 58% of revenue, is scores. But when it comes to net income, over 80% of profits is from scores. So they make most of their money from selling their credit scores. In terms of EPS, FICO's EPS grew 34.4% year over year. They are an incredibly fast growing company. And that is why they were trading at such a high valuation, but we'll get into that later in the video. The rapid growth has been due to the price increases that they've done on their FICO scores. So why has FICO dropped over 43% since its all-time highs? Well, this has to do with Bill Pulte and the Vantage score. Now, Bill Pulte is a government official working for the Federal Housing Financing Agency, and Bill Pulte is very critical of FICO. He put out a tweet on the 21st of May saying, after the hard work by many great senators, including Senator Tim Scott, I am extremely disappointed to hear about the cost increases by FICO onto American consumers. Now, this tweet alone managed to move the stock minus 28%, at which point I actually made a small position in the stock. It was a bad idea. Bill Pulte then went on to continue speaking on Twitter about the stock, and it dropped all the way down to about 1,500. It then climbed back up, and at this point I thought, wow, Bill Pulte is not done criticizing FICO. He is going to keep going. So actually sold out of pretty much all my position. It was a lucky escape because on July 8th, Bill Pulte then announced this on Twitter: effective today, to increase competition in the credit score ecosystem, Fannie and Freddie will allow lenders to use VantageScore 4.0 with no current requirements to build new infrastructure. This announcement made the stock drop a further 27%. The VantageScore is a separate score that is trying to attack FICO with their lovely wide moat here. To understand the moat, we must first understand FICO in the mortgage and lending industry. We're going to understand underwriting and the benchmarking side of the FICO scores. FICO, it does actually have the craziest moat. Your understanding will change forever, trust me. I think that once you see this, your opinion on FICO will drastically change. So, explaining this is going to be complicated, so keep your wits about you. So, loan origination and underwriting. So there's a borrower and the bank, and the borrower says, I want a loan of $300,000. The bank says, I need to check his credit history. I need to check whether he's going to be able to pay me the loan back. So he goes to the credit bureau. The credit bureaus, made up of Equifax, Experian, and TransUnion, the three big credit bureaus, they check the credit sources like applications, creditors, debt collectors, and they create 3 credit reports. But before they can give these reports to the bank, they need FICO scores. And FICO scores cost $4 a piece in each credit report. So FICO have just made a solid $12 there from one mortgage, essentially one loan of $300,000 for a mortgage, and FICO have made $12. Now the credit reports go back to the bank, and the bank says, yes, you can have the $300,000, and the borrower signs the contract saying, I'm going to pay back $400,000, let's say, over 20 years. So the bank's happy with that. It's going to make some money. But the thing is, the bank wants its money back now so it can loan it back out again. And to do this, there is a government-sponsored enterprise called Fannie Mae and Freddie Mac. And what they do is they are happy to take the contract of the loan and pay the bank $290,000. Now the bank, believe it or not, has made money during this process. During the process, they've taken various fees, thousands of pounds worth of fees, and they are actually in the green at the minute. So they've made some money. They've got their money back as well, and now they can loan it out to another borrower if they want to and repeat the process. This process allows Fannie Mae and Freddie Mac to build up a large number of mortgages, essentially a large number of mortgage contracts. And with those mortgage contracts, they pile them into a pool and they create something called a mortgage-backed security. Now, the mortgage-backed security is an asset that investors like you and I could buy, or usually banks buy. So these investors are attracted to the mortgage-backed security. Not like that, but they are attracted, and they say, we want to buy this mortgage-backed security. What are its return rates and its risk levels? So Fannie and Freddie say, well, it's got a yield of 4% because that's how much the loans are paying back. They're paying back 4% annually, let's say. And the average FICO score for the mortgages within the pool, within the mortgage-backed securities, is 717. Now, the investors can judge the risk and use their financial models. They can judge how risky it is using the FICO score. So this is how the secondary market works, and benchmarking. So FICO's benchmarking is really useful in this regard, because without it, investors wouldn't know how risky that asset is. So this whole system offers liquidity to the mortgage market, allowing the economy to run smoothly. And there are similar processes like this for all types of loans, like car loans or just personal loans, where they just get pooled together into some kind of security and then sold to investors. After the announcement that Bill Pulte made, essentially he said that Fannie Mae and Freddie Mac can use the Vantage score now, and they're not just confined to the FICO score. So why not just swap FICO for the Vantage score? Now the reason is that Fannie Mae and Freddie Mac would not be able to pile Vantage score originated loans and FICO score originated loans into the same MBS pool. So they'd have to separate the loans. Here at the top you can see a mortgage-backed security that was originated using FICO scores, and at the bottom, same with Vantage. So here you've got one with a yield of 4%, average FICO of 717, and the same here, yield of 4% and an average Vantage of 820. Now, the investors come along and they look at the FICO, the one with the FICO score, and they say, we understand how this works. After 50 plus years, we trust this. We know whether this is going to make us money or not. We can plug it into our financial models. We can see what happens, and we're probably going to buy this. And they come and have a look at the Vantage score, a new score. They're unfamiliar with it, and they go, look, we don't understand this language. What is an 820 Vantage score? They've never used it before. They don't know how risky it is. They don't know what the kind of credit risk is within this mortgage-backed security. And now they say, look, we need to recreate our financial models using Vantage now. This is going to take us time and money to do. And they're thinking Fannie and Freddie's risk models must have also been altered to adjust for the Vantage score. Can we trust it? They're also thinking, why did the lender use Vantage score in the first place? Is it because it gave them a higher score? Did they just pick Vantage score because it gave them the better score, which means that they could loan out them more money to them? And they come to the conclusion that, nah, we're not going to buy this. It's too much risk for too little reward. So they leave. And in order to get them back, we need to make this mortgage-backed security more attractive. So how do we do that? We quite simply increase the yield on the mortgage-backed security. So now the vet investors are back and they've seen that and they go, okay, we'll buy it now. Yeah, we'll buy it now. We quite like that. But how did we get the yield to increase? Well, essentially, the borrower and the bank said, look, mate, there's going to be a higher interest rate on your loan. There's going to be a higher interest rate on your loan, boy. So in order to get this higher yield, the mortgages have to return a higher yield, which means the interest rate for the borrower needs to be higher. And from the borrower's perspective, he's like, okay, I'll just go to a bank that offers a lower rate. And which bank offers a lower rate? Well, it'll be the bank that used the FICO score, because it only needs a yield of 4%. So that is why FICO's moat is just so incredibly powerful. FICO therefore has a huge moat in scores, and I don't think this is going to change particularly quickly. I'll give you some examples of this. So Toyota Motors auto financing unit, even though TMCC originates its loans using a VantageScore, TMCC uses FICO scores to describe its loans to investors. So TMCC even though it uses a VantageScore to originate and judge credit risk, it then has to buy a FICO score anyway and rejudge the loans within its pool in order to sell its pool of loans to investors. So even though they use a VantageScore, they then had to use a FICO score anyway. Another example is that One Main Holdings, which Citigroup sold in 2015, notes in its 10K that while management does not utilize FICO scores to manage credit quality, we group FICO scores into the following categories for comparability purposes across our industry. FICO itself notes that 98.8% of securitization solely cite FICO scores as a credit risk measure. I mean, look at that pie there. That is a slither, absolute slither for the rest of this credit scoring business. This is why FICO had such an incredible moat. This is why they traded at such a high valuation. I believe at one point they were trading at an 80 PE ratio, which is insane for a financial company like that. Now, because of FICO's moat, they have huge pricing power. And in November, FICO increased its price by more than 40% for mortgage originations. Just literally one go, bang, from $3.50 to $4.95, a 40% increase. But the thing is although this is a massive increase, you have to remember that this only makes up 0.2% of mortgage closing costs. So you've got a mortgage which is, $300,000. The closing costs are coming to thousands and thousands of pounds. The FICO score only makes up 0.2% of the mortgage closing costs. So it's really not affecting consumers that much. A little 40% increase is still very small. Here you can see some FICO mortgage score price estimates. So these estimates were made before Bill Pulte took more of a vicious stance against FICO. Seeking Alpha estimated that there'd be a 20% increase from 2025 to 2026 for score prices, and then 18, 16, 14, 12. So you can see the slow decrease in acceleration for their price increases. You can also see how quickly they have grown, starting from 0.6 or 60 cents all the way to 4.95 within 7 years. So really rapid growth, and that's showing their huge pricing power. Now, with the introduction of the VantageScore and Fannie Mae and Freddie Mac now being allowed to use it, how does this affect FICO? Well, we're going to see how much could FICO's revenue drop because of this. So scores make up 57% of revenue, as we saw earlier. So there's scores and software there. Now, Morningstar Equity Analyst Report estimates that mortgage revenue is about 40% of scores revenue. So we can then have a look at that, and that's 22.8% we've got there. Now, the FICO CEO on CNBC has said the conforming mortgage market, which is just mortgages that go through Fannie Mae and Freddie Mac, make up about 50%. So we've got 11.4% now. And now let's take a bear case on this and say that Vantage takes a whopping 20% market share. I think this is very unlikely. I really do. Just because of what I showed you before, the moat that FICO has, it's really unlikely that Vantage will be able to do this. You also have to consider that Vantage and FICO have actually been competing since 2006, and in that time, Vantage have managed to take less than 10% when it comes to the non-conforming mortgage market. So when we say that Vantage takes this whopping 20%, that means they take 2.3% of FICO's revenue. Just 2.3%. That is really not much, considering the stock has dropped 43% because of it. So we know how much the revenue could drop in the worst case scenario. But how much could FICO's net income drop? Well, in the same worst case scenario, we can see here that Vantage conforming mortgages, they would take 3.23% of FICO's overall net income. But I think when we're doing this valuation, we need to be looking at a base case here. So the base case, Vantage takes a 10% market share, which is 1.62% of current FICO net income. So we're going to be doing some estimations based off of this, and we're going to get to my valuation in a minute. So this is FICO's net income over the past 10 years, and here are my 3 imaginary quarters that I have added here, and these are the quarters that I can assume using FICO's current price structure with no price increases, and I've taken off a 1.62% of their net income because VantageScore has taken that. This gives us 715.6 million trailing 12-month income in Q1 2026. Now, here is some more presumptions that I've done 5.5 years into the future to the full year 2030, giving me a net income of 1.2 billion. What assumptions did I make to get to this number? Well, I said that there'll be no price increases until Q1 2027. So this is huge because I think that they are having more attention from the government and the Federal Housing Agency. I do believe that they are under pressure to not raise prices right now. So I've said no price increases until Q1 2027. So you can see it here, this segment here, no price increases. Now, after that, I've said that there'll be price increases of 13.25% annually from 2027 to 2030. So this entire portion here, there will be price increases, and there will be a volume increase in the amount of scores that are taken, 3% annually, only from this time period here to here. My fourth assumption is that VantageScore takes the 10% market share like we spoke earlier. Fifth assumption is that the software business goes up 3% annually. So from this, we've obviously found out that we have a net income CAGR of 12.5% with share buybacks of 3%. They actually average 3.7% share buybacks yearly. So I'm just going to go 3%, and this gives us earning per share of 58.07 in 2030. Now, when we look at this on a PE basis, exit multiple of 50, we get a 15% return from here, 15.4% return from here. I do think 50 is quite high. This is what the stock currently trades at, 50 PE. So I'm more leaning to the camp that by 2030, it would be trading at a 40 PE ratio. And that gives us a compound annual growth rate of 10.8%. So this really isn't, I don't think this is an incredible buy right now. If we were to increase that and say that there was a 15% net income CAGR, and how did I get to the 15% number? Well, I said that there would be 17% price increases from 2027 to 2030, which is also very likely. Seeking Alpha obviously predicted 20%. This is a mildly more bullish approach to the stock. This gives us an EPS by 2030 of $65, and then when you look at the PE of 50, you're going to get an 18% return. So if it stays at its current PE ratio, you're going to get an 18% return. When you look at 40 though, which is where I'd really be looking, a 13.3% return, which I don't think is going to outperform the market. So when it comes to my opinion on my buy price on the stock, obviously I bought very high at one point. I don't really have any money left in there. It's very minimal amounts, but the current price is 1,320, and my buy-in price, if I was going to buy in, would be 1,200. So if the stock drops down to here, I would make an entry position. It does have a crazy moat. I hope you guys understood the moat. I put a lot of time into trying to make it more understandable. My buy-in price would be about $1,200. I hope you enjoyed the video, guys. Subscribe, and I'll see you next time. Bye-bye.
I'm hopping out Ferrari, my house is 3 stories. I'm still independent cause Jive couldn't afford me. The meetings were boring, for real I was snoring. The VP was fine, yeah, she treated me kinda